All right, guys, with us once again tonight is Mark Collingsworth to tell us about the effects of the latest rate hike by the Fed, 25 basis points, another rate hike. Some people were predicting they would forego it this time because of the bank collapses, but they went ahead and raised it once again. Mark, what will be the consequences?
The consequence is that the Fed is stuck in a very hard situation. They have to keep raising rates because if they stop, they'll make the same policy mistake they made in the 1970s, which allowed inflation to run rampant, and it was very hard, which fostered in the recession of the 1980 1981. So they're going to have to keep raising rates, but if they keep raising rates, they're going to put more and more pressure on banks on their asset side of the balance sheet, as well as cause depositors. Because right now a bank you get about 0.1% on your deposit. Well, you can go to a treasury bill and get 4.7% in a T bill, which is a lot better than the bank and safer.
Well, Mark, some people were predicting that they might forego the interest rate hike this time around because of the bank collapses, but that didn't work out. They continue to raise it another 25 basis points. So what is going to be the effects? Drastic?
I think in the second half, it could get drastic. What the Fed has realized, it has to slow down its rate increases. So it's probably not going to be doing the 75 anymore, but I think it'll keep doing the 25 just to give the banks enough time to adjust to the higher rates on the balance sheets.
But again, the overall plan is to reduce inflation by creating job losses, layoffs, correct?
Correct. And that's the problem that they're facing right now. And what a lot of people don't realize is all this government spending, as you've seen, this big infrastructure bill that Joe Biden then passed last year, that's basically that money starting to flow into the economy. So even though the Fed raises rates to slow the economy, that bill, the Inflation Reduction Act, is actually creating jobs and it's working against the Federal Reserve right now.
Well, again, the Biden administration keeps telling us that things are improving, but you're saying the exact opposite is true if you really look at the data dispassionately, correct?
Correct. If you look at just the hard data, the economy is actually slowing, but jobs are being created because of the Infrastructure Act.
So the jobs are being created. So how does that play into the Fed's plan to create unemployment?
They're going to have to keep raising rates and keep doing their quantitative tightening process because the only way you can stop people from spending is you have to basically make them lose jobs.
So that will still be the effect then, or will the inflation reduction plan, the misnomer there, will it create enough jobs to counter the Fed's efforts to reduce jobs?
Well, that's the problem. Also, the Fed right now has to get the unemployment rate up to roughly 6% to 7% to actually get their inflation target down to 2%. So, for every 100,000 jobs that the Inflation Reduction Act creates, the Fed has to basically make sure 200,000 to 250,000 jobs are lost for every job created.
So how are they going to do that? More interest rate hikes and 25 basis points each time or higher?
They're going to have to raise 25 to give themselves a break. But here's the thing, they probably have already done so much damage at this point. They're going to keep raising interest rates, and you're probably going to see the problems get worse and worse with banks in these
Right.
later in this year. And not to mention, but while by them raising interest rates so much and then causing Silicon Valley and Signature Bank hedge funds, that was their number one short position, was to be shorting the short end of the curve, which is where the Fed's been raising rates. There's hedge funds right now that are actually rumored to actually be bankrupt because they took such a massive margin call on their bond positions on being on the short side.
For the layman out there, what is a hedge fund?
A hedge fund is an investment vehicle that's pretty much designed for the ultra wealthy to get into. People like Julian Robertson, David Tepper, the billionaires. Warren Buffett was actually originally started out as a hedge fund manager. And what these hedge funds do is there's really nothing that can stop them from investing. So with the retail investor, you have all these securities laws by the SEC that says, hey, you can't do this with a retail investor. You can't do that. You can't do this. Essentially, what those laws say is the SEC says, hey, we're going to put so many restrictions on you. We're not going to allow you to make money. But on the ultra wealthy, the sky's the limit. They can do anything. They can make massive bets on shorting the housing market. They can make massive bets on COVID, all kinds of things. If you can dream it, you can do it in a hedge fund.
So, Mark, then literally they are hedging their bets.
Technically, a hedge fund was originally designed when the first hedge fund came out in the 1940s. It was designed to do exactly that. It was to hedge bets. So let's say in the 1940s, you were a farmer with a soybean crop and you were afraid the price of soybeans would go down. Well, guess what? You could go to a hedge fund, and a hedge fund could basically protect that crop. If prices drop, they could be short, and you wouldn't lose any money. They could lock the current prices in. And because the hedge funds that were designed that way, they were exempt from a lot of the laws. So modern day hedge funds now go out and buy all kinds of stuff, leverage positions. I'll give you an example. If you buy a mutual fund these days, you might own, 50 to 100 stocks in it. There's some hedge funds out there that only own two or three stocks in their portfolios, and those two or three stocks are even bought on margin. Hedge funds can make you a lot of money, but at the same time, they can lose you a lot of money. That's exactly what happened with Credit Suisse. One of the hedge funds that was investing at Credit Suisse took like a $20 billion loss because they made a wrong bet in the stock market.
Well, the last time we talked, you were saying that more banks may be collapsing as we go along. Considering the latest interest rate hike, is that going to increase the probability of more banks collapsing?
I think you'll see more money drained out of the banks, and that could lead to more collapses. If you go back to 2008, when Bear Stearns was the first bank slash brokerage firm to go under, it it went under in March. You didn't actually start seeing other banks start to go under until about 4 months down the road. So Bear Stearns was the first casualty, and like I always say, when you have these companies go bankrupt, they're like cockroaches. You're not going to see just one in your house. There's multiple coming. You just don't see them yet.
Well, here's another factor that could enter the picture here. The 2024 is coming up, and Biden is already moving to the center and making unusual support for programs and efforts he hadn't supported before to become more appealing to disgruntled voters. So, is there anything he could do economically to pull the economy up in time for him to get reelected in 2024 if he runs?
What they need to do is all this spending programs. It seems like they're basically trying to buy votes with all these, trying to, lower taxes here, do these stimulus checks here, do the infrastructure bills. They're doing all these things that basically are putting more regulations out there and putting more stress on companies, and at the same time giving away free money. That's the worst thing they can do. They've got to get inflation down first, and that's going to take some hard political choices.
Okay, but the free money, the giveaways, short term, won't that work for him politically to get him reelected?
It will work for him short term politically, but the problem is because we have an inflation problem now where demand is outstripping supply, those short term things they're doing is going to cause long term problems for the economy.
All right. Also, before we close, globally, are the ripple effects continuing to spread? It's not just American banks in trouble. Globally, there is also some problems.
Well, correct. This past week, Credit Suisse went under. They had about $17 billion in what's called these A1 bonds, or nicknamed Coco bonds. Those bonds are supposed to actually save banks in Europe from actually going bankrupt. Well, what they did, back up. The Coco bonds are supposed to convert into equity if a company gets in trouble, so that way the company becomes debt free. What they did in this situation is they basically got rid of the bonds and didn't convert them to equity, and so there's about $17 billion that got wiped out. Problem with that, now no one wants to buy these Coco bonds. So Deutsche Bank, which is now on the chopping block that a lot of people believe is the next major bank in Europe to go bankrupt, their Coco bonds are now yielding 25%. So the main thing that was keeping Deutsche Bank alive, they can't issue more bonds at 25%. And nobody wants to buy them because they're afraid they'll take 100% loss like they did in Credit Suisse. So Deutsche Bank is in a lot of trouble right now in Europe.
Mark, what do you think in terms of balance, pros and cons? Would it have been better for Powell to forego another rate hike this time around? I mean, he has to bring inflation down, but considering the bank failures and everybody, starting to be very even more anxious, would it have been better for him to just not raise rates this time around?
Well, no. And the reason why is the week before Signature Bank and Silicon Valley Bank went, the forecast was like an 83% chance it was going to be a 75 basis increase. And it
Right.
went from 75 basis to 25 basis. And of course, the Fed's been saying, hey, the banking system's solid. There's no problems. Just like Ben Bernanke said the exact same thing in December of 2007. If they had not increased interest rates, that would have sent a message that the Federal Reserve is panicked, that the system is starting to break down. That's why they only did 25 points. It still allowed them to raise interest rates. It allowed them to keep saying, hey, the economy's still strong, the banking system's strong, but it still was a rate increase to sit there and basically try to slow the problem down as well.
Now, Powell indicated months ago that the public should not expect any relief in interest rate hikes until next year. So apparently that's still on course now, considering he just raised it again.
Correct. I have a feeling they've already done so much damage already to the banking sector that probably here in the next 6 months, they're probably going to have to actually start cutting interest rates because just like, in 2007, they raised interest rates way too much and kept on raising them after that. And that's actually what caused the '08 bubble to pop. I think here in this situation, they've raised interest rates too much, but we just haven't seen the full effects of it yet.
So you think before the end of this year, he'll stop raising interest rates, or that won't happen until the beginning of next year?
I think by the end of this year, they'll actually end up cutting interest rates.
And that in turn will have what effect? How soon?
When the Fed starts cutting interest rates, this is what happens. All holy hell breaks out. And the reason why is the Fed only cuts interest rates when things are going to hell in a handbasket. And it's going to be a very, very bad situation. As the old saying goes, when the Fed makes their last interest rate hike, start getting in cash because everything's about to fall apart.
All right, now wait a minute. Before we close, you're saying that they'll probably stop raising interest rates within this year, before the beginning of next year. And once that happens, all hell breaks loose.
All hell breaks loose. The Fed only cuts interest rates when things are falling apart. They never cut interest rates when everything is all sunshine and Mickey Mouse ears.
So going into 2024, what can we look into? What can we look forward to?
You'll probably have a much better buy. If you're looking at buying stocks, you'll probably have a much better buying opportunity probably towards the end of this year or even maybe next year.
Well, I mean, you're saying all hell is going to break loose, so I don't understand where we're going.
Oh, because when all hell breaks loose, I mean, in December of 2008, I was having a party buying all the stocks that were trading at such cheap valuations. For a stock picker, I love to see things go to hell in a handbasket.
All right, so stocks will be a good bet then.
Yeah, after they drop 50%.
So in other words, you're buying low and then you wait for them to go up. So that's the plan going into next year when they cut interest rates.
Yep.
Okay. Mark Collingsworth at Vere Global Wealth Management. Thanks for the update and more to come. So stick with it. Hey, and by the way, the hat. Now, we said the last time, some people hate your hat, but other people love it and they want to know where they can get one.
I actually got this one at Star Wars Land at Disney, and this is my other Disney cap here. This is actually a collector's item. It's actually a 50th anniversary hat. I wish I'd actually knew that at the time because I kind of scruffed it up a little bit. So now it's not mint condition, but if I know at the time, I kept it in mint condition.
Well, I think, if demand continues, we're going to have to create a Mark Collingsworth hat, signature hat, and all the fans could put on their thinking hat cap when they're buying stocks and making investments.
That's right.
All right, Mark Collingsworth, thanks very much for being with us, and we'll talk again soon. Thank you.
Thank you, Larry. And as always, it's always the darkest before it goes to hell in a handbasket.
That's your sign out. Okay, Mark.
Yeah.
See you later.